Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is April the 8th, 2016, and this is the Daily Report for Gold and Silver, our weekend review in which we combine it with trending markets to give you a better overall scope and sense for activity this week in the markets overall. Traders, first to gold. We did put out a trade recommendation this morning recommending that subscribers get long gold at the market. Market was trading at approximately 1240 at that time. Seems as though settlements around 1241.40. Now, the low on the day has been 1231 and the high 1244.60. So as you can see, we're closing about $5 off the high on the day. Let's take a look at our first chart. So traders, first chart that I do want to look at on today's weekend review is a shorter term. It's a half a day gold chart, standard candlestick format, in which we do have our current Elliott wave count as well as a fib retracement, although that's not as critical. There's absolutely no doubt we hit some lows back at the beginning of this year that in hindsight are going to prove to be the absolute bottom within the market. Now, when I say absolute bottom, I'm talking about the fact that we're now well over $1,200 per ounce. Market was trading at about $1,040, $1,050 at that time. From that point, my belief is that we basically went into a new Elliott wave count that's all part of a major B wave. And we'll look at that B wave and this particular chart in context to that in a second. But within that B wave, I am looking for a move, and a pretty substantial move. But I also believe that that's going to be a multi-year move. But in essence, what we're looking at is waves 1, waves 2, this tremendous extended long wave 3. From there, we do go into a compression triangle, which composes our wave 4. That concludes roughly at about, I'll call it 1220, but right in this area. From there, we went to our fifth wave, and that completed a subcount 1. You can see that in red. That color and the fact that it's a subcount will become important once we pull up our weekly chart. Now, from there, I believe we went into some sort of a correction. Now, whether we want to label it as a ABC, which is how I first initially labeled it. However, what happened is the market came up, hit these highs at about 1241, and then moved back down here. So what I've now done is, my belief is we had yet another compression triangle in the marketplace in which we had 1, 2, 3, waves 4, waves 5. That concluded the actual correction within the market, and now we are back into a impulse stage, meaning we'll get waves 1 through 5 as we move up the ladder to higher pricing. Now, that was one of the primary reasons that we actually went and issued a buy signal yesterday, and that was because when we consider these series of lower highs and higher lows, we had a defined breakout yesterday. Although in evening session it did come down a little bit, you can see it did not go into the area of this compression triangle and then close nominally higher on the day at 1241.60. So traders, the chart that we looked at just prior to this chart, a half a day chart, but as I said, very, very short term. Now, this is a daily chart, but it's highly compressed so that we can get in the major fifth that concluded, of course, at record highs about 1920. This long protracted move down, as we've talked about on many occasions, I believe was a major A, which takes us now into a major B. Typically on a B wave, that will go anywhere between 50 and 75% that of A. And this 1480, which is my upside target right now, is simply a 50% move of the move down. Now, when we look at it in its entirety, red in this case is intermediate and blue in this case is the subcount behind that. And so what we're looking at, of course, if we take this all the way down to the conclusion of our fifth wave intermediate, our fifth wave, our subcount, as well as our major A, I believe we hit a bottom, and that started the cycle of a B wave. On this B wave, we have had our wave 1. That is what we just looked at in terms of the market move from these lows at 1040 up to these highs at about a 1288. The correction that we have recently just gotten out of hit a low of about 1206. You can see 1205 were our numbers between 1195 and 1205. So did meet that criteria. And my sense is now we are going into an extended impulse wave. And that impulse wave will, I believe, take us over $1,300 per ounce. And that is one of the primary reasons we have been looking for the proper positioning to get long this market. Very interesting day in U.S. equities as well as the week. It does appear as though the U.S. equities markets are closing lower on the week, higher on the day, although well off of the highs. Dow Jones Industrial Average 17,576 puts it up about 35 points on the day. However, when you look at what the high was, which was 17,694, you can see we're over 100 plus points off of the high on the day, a low 17,028. So we are closing a little bit off the lows, and we are closing in positive territory. Standard & Poor's 500, this of course is the E-mini, 2040 up 5.25 points on the day. The low has been 2030 and the high 2054. So traders, we're looking at the Standard & Poor's E-mini contracted daily chart, daily candlestick chart. And the one thing that we can say is that we absolutely have run into an area of consolidation and congestion. Now, we've hit these areas before, but we've typically hit them around the highs, in which you'll have a period of time, such as right in here, in which the market trades within a defined range, attempts to make a top, and then trades lower. We've got a similar activity. Defined sideways action comes in, makes a higher high right in here, and is now trading lower on the day. However, it has been a tough read at best when we consider the activity this week, because starting on Monday, we had this down day, which we identified as a dark cloud cover. We actually got confirmation of the dark cloud cover, indicating lower pricing in terms of straight candlestick patterns. However, we're still well above the 200-day moving average. So because of that, we believe that we could be looking at a minor consolidation in the market. We get this huge spurt the following day, this being Wednesday, and then yesterday, this tremendous down day, followed by a moderately higher up day. So we have had, if you take a look at the last 4 trading days, absolutely alternating candles. And when we get alternating candles, that spells congestion to me. We'll have to see how this market unfolds, because the interesting thing is we have seen a positive correlation between crude oil and U.S. equities, and we have also seen over the last couple of weeks a decoupling of that relationship, and now have almost a negative correlation between that. And we'll look at that when we look at our first oil chart. Tremendous upside move in oil today, up over 6% on the day, $2.30 approximately per barrel in terms of the rise, to see crude close at $39.54. The most interesting thing, and we'll look at this on our first chart for oil, is the fact that we have seen a decoupling or a negative correlation between U.S. equities and crude oil. I think that's critically important, and it's something we'll want to take a look at as we pull up our first crude oil chart. So crude oil absolutely closed higher on the day, higher on the week, 35.13. That's where the market opened on Monday. The close, meaning today, it's going to close near the highs at about 39.52. Each candlestick represents a week in trading. On the bottom, I have the S&P 500. We hit bottoms in this market here about mid-February. We also hit a bottom in crude oil about mid-February. And from there, if you look with green candle to green candle, you have almost an absolute solid correlation then for the next month, month and a half. However, look at the last couple of weeks. Last week, of course, we had a down week in oil, but we had an up week in U.S. equities. This week, we have higher oil prices, and on the week, we have a lower U.S. equities market vis-a-vis the S&P 500 E-mini, or if you look at the Dow Jones Industrial. So what we can absolutely say is that we have seen a decoupling between crude oil prices and U.S. equities, and we have gone from there being a positive correlation, meaning up equities, up oil, I should say, because it was leading the way, to a negative correlation between U.S. equities and crude oil, and I believe that's a good thing. Now, as far as the U.S. dollar is concerned, it is going to close lower not only on the day, but on the week. But as you'll see when we pull up a weekly chart, the U.S. dollar, in terms of the actual move itself, has not been as significant as we have seen over the last couple of weeks. Nonetheless, we do have a lower U.S. dollar on the week. So this is the weekly chart that I just spoke about. And as you can absolutely see, this activity this week was not as dramatic of a drawdown as we have seen in previous weeks, such as here, or especially this week here that came at the beginning of the year. But nonetheless, dollar remains under pressure. Now, we have identified a series of bottoms that come in at around 94. Market closed at 94.22. So the interesting thing that we'll want to look at next week is whether or not this particular level at 94 holds. Because if it does not, the next real level of support in the U.S. dollar is 93 on the index. No doubt, this has been a most interesting week with some extreme volatility in a few of the markets that we looked at. We are long gold. We have our current stop in place. My recommendation is to maintain your current long position in gold, to maintain your current stop. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for another daily update and review. Bye-bye.